As of 10:25 a.m. Eastern Time on this Friday, October 31st, 2025, the market is fully active and Amazon.com Inc., ticker PAMZN, is absolutely surging. The stock is currently trading at $247.21, which is a massive gain of $24.35, or nearly 11% on the day. This isn't a small move. This is one of the world's largest companies reacting violently to news, having gapped up at the open to $250.10 and hitting a new 52-week high of $250.50 before seeing some early profit taking. Now, everyone watching the market today sees that 11% gain and immediately, correctly, attributes it to the blockbuster third-quarter earnings report released last night. That is the expectation. Big numbers, stock goes up. It's the simplest story in the market. But the reality of what is happening under the hood is far more significant. This isn't just about one good quarter. This is about the entire market being forced to admit it was fundamentally wrong about Amazon's two most important businesses, cloud computing and retail logistics. The consensus narrative that has been building for a year has been shattered in a single evening. Let's establish what that common narrative was. The expectation, held by many large funds, was one of persistent caution. The story was that Amazon Web Services, AWS, the company's profit engine, was facing a severe and prolonged slowdown. We heard the word optimization constantly, which was just a polite way of saying that its largest customers were cutting back on their cloud spending. On the retail side, the consensus was that the post-pandemic consumer was tapped out, advertising spend was weakening, and that the billions upon billions Amazon poured into building out its one-day delivery network was a colossal capital expenditure that would crush margins for years to come. Last night's Q3 report did not just challenge that narrative, it completely invalidated it. The reality is that AWS growth did not just stabilize, it re-accelerated. The company reported AWS sales grew 20% year over year to $33 billion, blowing past the highest analyst estimates. This is the fastest growth rate AWS has seen since 2022. The optimization story is over. CEO Andy Jassy confirmed that they are seeing strong demand for AI services and that new workloads are ramping up, not slowing down. Simultaneously, the retail business, far from being an anchor, demonstrated incredible operating leverage. Those massive logistics investments are now paying off, leading to record delivery speeds and, most importantly, expanding profitability. The market was positioned for a continued slowdown, and it was handed a story of re-acceleration and efficiency. That is why we are seeing this explosive move today. This isn't a small cap stock moving on a rumor. This is a $2.6 trillion behemoth adding hundreds of billions in market value. The trading volume is already astronomical, hitting over 64 million shares in just the first hour of trading. This is more than its typical full-day average. This level of volume signifies massive institutional participation. This is not just retail investors chasing a stock. This is large-scale programmatic buying from hedge funds, pension funds, and mutual funds that were underweight or, in some cases, short, and are now scrambling to correct their positions. This is a full-scale institutional chase. This move is even more impressive given the macroeconomic environment. We are still contending with a high interest rate world that has been systematically punishing high multiple growth stocks. But today, Amazon is proving that it is not just a growth stock. It is a durable, profitable, and essential enterprise. In a market starved for reliable, large-scale growth, Amazon just served up a feast. This report has firmly re-established its leadership within the Magnificent Seven and has forced a complete repricing of what its future earnings stream looks like. Dozens of analyst firms are on the wires this morning, from Oppenheimer to Morgan Stanley, racing to upgrade their price targets, with some now pushing well past $300 a share. Now, whenever you see a powerful move like this, it is essential to understand the other side of the trade. We must talk about the short sellers. Who was betting against Amazon and what is happening to them today? Let's be perfectly clear. Amazon is not a meme stock. It is not a fundamentally broken company with a massive targeted short position. In fact, its short interest is very low. According to the most recent data from Nasdaq, the short interest as a percentage of the float is just 0.77%. That is an exceptionally small number. But here's the critical distinction. Because Amazon's market capitalization is so vast, that tiny 0.77% still represents an enormous amount of capital. We're talking about roughly 74.5 million shares held short. At yesterday's closing price, that was over $16.6 billion. Today, at 247, those short sellers are facing catastrophic, multi-billion-dollar paper losses. These are not small retail traders. These are large institutions that were likely running a thesis-driven short. Their thesis was that the AWS slowdown was structural and that Microsoft's Azure was permanently eating its lunch, or they were using Amazon as a liquid macro hedge, a simple way to bet against consumer spending. As of 10:25 a.m., that thesis is in ruins. The explosive volume we are seeing is not just new buyers coming in, it is also a significant amount of that $16 billion in short positions being forced to cover. They are being forced to buy back shares at a massive loss, and their buying is adding even more fuel to this upward spike. This brings up a key point for every investor. You need to know how to find and interpret this data. You can find short interest figures on major financial sites, and it is usually updated twice a month. But don't just look at the percentage. You must also check the borrow fee rate. For a giant liquid stock like Amazon, the borrow fee is incredibly low, currently around 0.41%. This means the stock is very easy and cheap to borrow. This is not a situation where short sellers are trapped by a lack of available shares. A squeeze here is not happening because of a supply and demand issue for borrowed shares. The pressure is 100% fundamental. The short sellers are not being squeezed. They are simply fundamentally wrong. This brings up my first question for you. What's your take on this? Do you think the institutional short thesis on Amazon's cloud business was a reasonable, calculated risk that just failed? Or was it a fundamental misreading of the company's dominance? Let me know your thoughts in the comments. Looking at the broader retail sentiment on platforms like X and Reddit, the mood is, as you can imagine, one of total vindication. But the discussions are more sophisticated than just stock go up. People are dissecting the conference call, debating the long-term margin potential from AI workloads on AWS, and analyzing the $9.5 billion pre-tax gain from the investment in AI company Anthropic. This is an investor base that has been holding through a long period of doubt and feels that last night's report validated their long-term conviction. For anyone who is new to this name, it's important to step back and understand what Amazon actually is, because the market has misunderstood it for years. It is not just an e-commerce store. It is, in reality, three distinct, massive businesses. First, there's the North American and international e-commerce business. This is a low-margin, high-volume logistics and retail operation. Second, there is the advertising business, a high-margin giant hiding in plain sight, which grew 24% this quarter. And third, the crown jewel, AWS. AWS is the cloud computing backbone for a massive portion of the global economy. For years, the market valued Amazon as a retailer, but the reality is that it is a high-tech cloud company, an advertising powerhouse, and a logistics operator, all in one. The stock's history reflects this, with a huge run-up in 2020 and 2021, followed by a painful 2022. The 52-week range with a low of $161.38 and today's high of $250.50 shows just how volatile this prove-it story has been. So the critical question is, where does the stock go from here? The market has now priced in a new, more optimistic reality. The expectation has been reset. The catalyst for the next leg higher will be confirmation. The market now expects AWS to continue this 20% growth and for AI to be a meaningful contributor. If the next 2 quarters confirm this new trend, analysts will be forced to raise their earnings estimates for all of 2026 and 2027, which is what truly drives a stock price long term. The risks, however, have not vanished. The primary risk is still the macroeconomy. a severe global recession would absolutely slow down cloud spending and e-commerce. That risk is real. Furthermore, competition is relentless. Microsoft and Google are not standing still. They are also investing tens of billions of dollars into their own cloud and AI platforms. And let's not forget the regulatory overhang. Amazon is facing significant legal action from the FTC, and while the $2.5 billion settlement charge this quarter was a known issue, the regulatory scrutiny is a permanent dark cloud. The expectation moving forward will be of execution. The market has given Amazon its vote of confidence, but it will be watching every data point. The reality is that the path from here will still be volatile. The key for investors is to differentiate between short-term noise and a genuine change in the long-term narrative. Before we finish, I have to ask you to participate. Comment below. How many shares of Amazon do you currently hold, or are you looking to start a new position after seeing this powerful report? In the end, the story of Amazon today is a powerful lesson in expectation versus reality.